In less than 10 months, the rules on inheritance tax and pensions in this country are changing in a way that could cost your family 40% of your pension savings. And right now, the vast majority of people with a pension pot have no idea it is coming. From the 6th of April 2027, unused pension funds will be included in the value of your estate when calculating inheritance tax. Right now, pensions sit completely outside the inheritance tax system. You could have £500,000 in a pension pot, and when you die, your children inherit it without a single penny going to HMRC in inheritance tax. That is why the most common retirement strategy for the last decade has been to leave the pension untouched, spend your other assets first, and pass the pension on as a tax-free legacy. From April 2027, that strategy is dead. Here are 5 things you can do right now before the new rules take effect to protect as much of your pension as possible for your family. Thing number 1 is to understand exactly how much of your estate is at risk. Inheritance tax is charged at 40% on everything above the nil rate band. The nil rate band is £325,000 per person. If your estate includes a home being passed to direct descendants, you also get the residence nil rate band of £175,000. That gives you a total of £500,000 that can pass tax-free, or £1 million for a married couple combining both allowances. Right now, your pension is excluded from that calculation. From April 2027, it is included. So take a piece of paper and add up the value of your home, your savings, your investments, and your pension pot. If the total is above £500,000 for a single person or £1 million for a couple, the amount above that threshold will be taxed at 40% when you die. Here is what that looks like in real numbers. A single person with a home worth £350,000, savings of £50,000, and a pension pot of £200,000 has a total estate of £600,000. Under the current rules, the pension is excluded, so only £400,000 counts. That is below the £500,000 threshold, so the inheritance tax bill is zero. Under the new rules from April 2027, all £600,000 counts. The amount above the threshold is £100,000 and 40% of that is £40,000. That is £40,000 your family will have to pay that they would not have owed under the old rules. The government estimates that 10,500 additional estates will become liable for inheritance tax because of this single change. If your total estate, including your pension, is anywhere near the threshold, you need to plan now while you still have 10 months. Thing number 2 is to review who your pension is left to. Pensions passing to a surviving spouse or civil partner remain completely exempt from inheritance tax under the new rules. Nothing changes for married couples or civil partners in this respect. If your spouse inherits your pension, they pay zero inheritance tax on it, regardless of the amount. This means the people most affected are those leaving their pension to adult children. If you are widowed or single and your pension is nominated to go to your son or daughter, that pension pot is now inside your taxable estate from April 2027. If you are married and both of you are still alive, your pension passes to your spouse tax-free, and the inheritance tax issue only arises when the second spouse dies and the pension passes to the next generation. Check your pension nomination right now. Log into your pension provider or call them and confirm who is listed as your beneficiary. If it is your spouse, that is fine under the new rules. If it is your children, the rest of this video is specifically for you. Thing number 3 is to consider drawing down your pension strategically before April 2027, instead of leaving it untouched. This is where the old strategy flips completely. For the last 10 years, the advice has been to spend your ISAs and savings first and leave the pension alone because it sat outside inheritance tax. From April 2027, the opposite may be true. If you draw money from your pension now, you pay income tax on the withdrawal at your marginal rate. For most retirees, that is 20% on income up to £50,270. Once the money is out of the pension and in your bank account, you can then gift it to your children. Gifts become fully exempt from inheritance tax if you survive for 7 years after making them. So the maths works like this. You withdraw £50,000 from your pension and pay 20% income tax, which is £10,000. You give the remaining £40,000 to your children as a gift. If you survive 7 years, that £40,000 is completely outside your estate, and your children keep every penny. If you had left that £50,000 in the pension and died after April 2027, 40% inheritance tax would take £20,000, and your children would also pay income tax when they draw it down, potentially leaving them with as little as £18,000 from the original £50,000. Drawing down and gifting is not right for everyone. It depends on your income, your tax band, your age, and how much you need the pension for your own living expenses. But for anyone with a pension pot they do not plan to spend in their lifetime, this is the single most important calculation to run before April 2027. Thing number 4 is to consider whether an annuity makes more sense now than it did before. An annuity converts your pension pot into a guaranteed income for life. Once you buy an annuity, the capital is gone. There is no pot left to be included in your estate, and therefore no inheritance tax on it. Before the 2027 changes, annuities were often seen as a poor deal because you lost the ability to pass on the remaining pot to your family tax-free through drawdown. That advantage disappears in April 2027. If you are a single person with no spouse to leave the pension to, and your estate is above the nil rate band, converting some or all of your pension into an annuity removes it from the inheritance tax calculation entirely. Annuity rates in June 2026 are at some of the highest levels in over a decade. A 66-year-old can currently get roughly £6,000 to £7,000 a year of guaranteed income for every £100,000 of pension pot. That is income for life that cannot run out, cannot be affected by stock market crashes, and is not subject to inheritance tax. This does not mean everyone should buy an annuity. If you are married, your spouse can inherit the pension tax-free, so the inheritance tax argument does not apply. And if your total estate is below the threshold, inheritance tax is not an issue regardless. But for single retirees with estates above $500,000, annuities have suddenly become a much more attractive option than they were 12 months ago. Thing number 5 is to get professional advice and do it now, not in March 2027. The interaction between pensions, inheritance tax, income tax, the 7-year gifting rule, the nil rate band, the residence nil rate band, and the taper that removes the residence nil rate band above £2 million is genuinely complex. A single mistake in how you structure withdrawals or gifts could cost your family tens of thousands of pounds. An initial consultation with a financial advisor who specializes in retirement and estate planning typically costs between £200 and £500. That conversation will tell you exactly where you stand, how much of your estate is at risk, and which of the strategies I have just described applies to your specific situation. Do not wait until February or March 2027. By then, the advisors will be overwhelmed with people who left it too late, and the good ones will have full diaries. Book it now in June or July 2026, while there is still time to implement whatever they recommend. The 7-year gifting clock starts the day you make the gift, not the day you get the advice. I will put all the links and details in the description below. Let me leave you with the number that matters, 40%. That is the rate at which HMRC will tax your unused pension pot above the nil rate band from April 2027. For some families, that is £20,000. For others, it is £50,000 or more. And for every single one of them, the difference between paying it and not paying it comes down to whether they planned in the 10 months before the deadline or found out about it after. Send this video to one person who has a pension pot and has not thought about this. A parent, a sibling, a friend. Because HMRC is not going to write to them and explain what changed. The letter they receive will be the one after the funeral, and by then it is too late. I will see you in the next one.